Right. Right. Good morning. Today is the last day for this semester. Up to now, we discuss the source of income and also how to compute the income of each source, and also how to compute the tax liability individual, tax liability of the partnership, and also how tax computation method of partners. In addition, we discussed the corporate taxes. Under that, we learn how to compute the corporate tax liability and the dividends tax liability, and also the deductible tax liability. In addition, we learn value added tax and NBT, and also the ESC. Now, other part of the this subject is especially for this syllabus include the tax exemption and planning. Today, I am going to discuss the tax exemption and planning. When we start this, learn this subject, we studied and also we learn and we have idea that why government is imposed, all the governments worldwide, they impose taxes. The first objective of the tax system is raise revenue. In addition to that, there are so many other objectives. One other objective is the encourage the capital formation for the investments. The country's capital formation also increase through the tax systems. For that purpose, according to the scope charged with the Inland Act, any income or profit derived of any person is subject to taxes. But anyway, Section 2 very clearly identify taxes charged subject to the provision of this tax. What are the subjective? This under subjective. When we read the 11 Act in the context, we can find there are so many exemptions and also some reduced rates. Different rates are applied in different schedule. In some cases, some tax brackets are the individuals are taxed in progressive rates, but corporate are taxed at standard rate. Though the standard rates are applied to the corporate, if the corporates are engaged in different type of businesses, the tax liabilities depend on the nature of business, and also tax exemption of the reduced rates interest by the specified by the under the Inland Revenue Act. And therefore, we must learn what are the tax exemption under the Inland Revenue Act. If we read the Inland Revenue Act, there are so many exemption provisions. Section 13. Section 13 deals with several exemptions. Section 11, 12, and all these sections deal with the tax exemption. Tax exemptions are different kinds. Ones are the tax holidays, tax incentives, like that, and same with some tax incentives only for a reduced rates for a certain period. Likewise, for that purpose, before that we learn that one, we must know one objective of the taxation is encourage the investment or the capital investment of the country and all the capital formations. Capital formation is normally called the government or the private sector investing in fixed assets, land, building, or other plant and machinery. All this for that purpose in Sri Lanka. Lot of investment of the infrastructure are done by the government. Private also expands in their businesses, and thereby they also form the capital, and therefore we must learn the capital formation of the countries constitute two elements. One is the public sector contribution and also the private sector contribution. Then the governments can anytime spend any amount of money for the capital formation of this country. Like in current Sri Lankan governments is spending heavily in the roads, electricity, and the healthcare sectors. for healthcare sector, for that purpose, they are construction building on also, we are purchasing lot of plant and machineries. And if we take the road and construction, the lot of roads are constructed, highways and all. In irrigation and the agriculture, there are a lot of tanks. There likewise the Moraghat, and those are come under the capital of this country. One the government is decided to build a university, that is become the property of the government. That type of fixed investments and expenditure we call the capital. For that purpose, if the country, the government also spending the for the increase the capital of this capital of the country. That is we call the capital formation. If the private sector also they are expanding their business, they also construction building, when they expand building, they buy plant and machineries. Likewise, they are spending for heavily in the capital. That's if then that is that type of process, expanding process we call the capitalist formation. Today, one company has the 100 million assets, and if the next year is become the 200, that means during the year he has spent more than 100 million for a capital investment. Their capital is formed by increased by 100 million. Through that type of formation, always depend. See, if the first we take in the absence of any taxes, if the corporates made 100 million rupees, then if the company management wishes to invest 100 million, they can invest in the expansion. But say if that means they can save the 100 million or they invest in the capital. Say that where the situation that tax system is implementing the corporate tax and say of 30%, then if the 100 million is made as a profit, if the tax of 30% is paid, only they retain the 70. Then that 70 goes for the capital formation of the shareholders. And therefore, we must learn then that they depend on the taxability of the corporate or the individual. Their saving amount is depends. In the higher rates, individual the corporate are taxed. In the taxpayer's hand, their retained earnings is less because when they paid the taxes, that amount to be reduced from the profit. Say that if the 1,000 million profit made by a company and 200 million paid as a tax, then they retain only for 800 million. But now, since they had to pay taxes, their retained earnings were reduced. But in the situation where the tax system is absent of the tax system, the profitability tax and lower rates, so the exemptions are given, the taxpayers can save more money for investments, right? And that purpose, though the company made profit, government give the tax exemption, they are not investing, and all the shares are enjoyed by shareholders, no capital formation comes. But government always hopes when the tax exemption or tax rules are given, government genuinely hope that the people they retain their money without paying taxes, and their retained amount will be invest in their future expansions of businesses. Likewise, that is as a concept, all the tax administration in the world has accepted that through the tax systems of the country, the capital formation can be increased, or the business sector can be encouraged to make more and more investment. But in case of government capital formation or the public sector capital formation, tax system is not much depend. But anyway, if the government revenue can be increased through the tax system, the government collect more revenue, and thereby government also can spend same amount money for the capital formation in this country. And therefore, the masterly students, the big good research topic is the tax exemption or effect of tax exemption or tax holiday for the country's capital formation. How the government achieve their objective through the increase the capital of this country through the tax system. Likewise, now when we talk about this tax exemption, when we go for the history, in king's time also, the kings is introduced for the citizen to pay taxes. All the people of the citizen had to pay taxes for the kings. But in some times, agriculture was taxed. Some farm of this country visited the king and appealed them, sir, the king, saying that due to the heavy drought, our harvest was destroyed. Now we are not in a position to pay taxes. That is in present context, that is by way of appeal of the one lobby group. Farmers lobby the kings and requested our harvest, agricultural harvest was destroyed by the heavy drought or the floods. Then we are not supposed to pay taxes, and also said then we are receiving the harvest in periodically, and therefore we have no cash flow to pay taxes. Or considered all those facts, then kings said, right, farmers should not pay taxes. On that way, exemptions were given. Having receiving that information, the country's fishermen also went to the king and asked, sir, our honorable king, we also like farmers. We are also not in a position to pay taxes. In some period, we are not able to fishing. Then we also need give some relief to pay taxes. Kings consider the fishermen request and also gave some relief for the fishermen. Likewise, or even our history of taxation, tax exemptions were available for a special category considering the fact that they have forward to the kings. Kings analyze the position, and if it is a very reasonable request, the kings consider they are relying upon the payment of taxes. Likewise, today the global tax system identify the tax exemption. Now in Sri Lanka, under the 11th Act, lot of tax exemptions have been introduced. In Sri Lanka, when we talk about the tax exemption, there are two regimes giving the tax exemptions. That is accepted fact that in Sri Lanka, the investment arm of the government is the Board of Investment of Sri Lanka. We simply say is the BOI. BOI's main objective is encourage the investment, foreign direct investment, FDI, and also the local investment. They have advised certain industries to be needed to be developed, and accordingly they have published some gazettes, and they have given the investment amount criteria and the facility that are available for the investors, and thereby the BOI promote the local and the foreign investors to come to Sri Lanka and make investment. In Sri Lankan history, recent history, in 1978, once the government, Sri Lankan government was liberalized and also they accept the open economic policy, those days President J.R. Jayawardena, he established the Greater Colombo Economic Commission. Under the Greater Colombo Economic Commission, they established the pre-trade zones in the Katunayaka, and the president of this country, through their Greater Colombo Economic Commission, that was the investment promotion of the country in those days. They request for the world investors to come to Sri Lanka and invest. They facilitate for that purpose. They established the industrial zone in the free trade zone in the Katunayaka. Those who came to the in Sri Lanka, especially the apparel and a lot of industries, they heavily invest in the in Sri Lanka within the Katunayaka free trade zone. Government through the GCEC Greater Colombo Economic Act was passed, and thereby they had power to give the tax exemption. Under the that authority were up to 1970, only the Inland Act had the power to permit the tax exemptions. But in 1978, the override provision was introduced to the GCC Act, Greater Colombo Economic Act, and Greater Colombo Economic under the Greater Colombo Economic Act. Once the investor agreed, reach an agreement with the GCEC, make some investment for the particular purpose, the government was for some tax holidays. Times some tax holidays forever, no any limited, no any period. In some cases, for 10 years, 15 years, or 20 years, depending on the nature of business and the amount of investment. Likewise, tax exemptions under the GCC Act also grant. Then later, that act was amended as Board of Investment law. Under the Board of Investment same law, that law was changed. Now very recently, now tax sections or tax holidays are not given by the under the BOI. Now all the powers are given to the all the powers are vested to the Inland Revenue Act. Or now only under the Inland Revenue Act can grant the tax holidays or the tax exemption. Now it is as a policy decision. Government also for 2017. Now government also not giving more tax exemption, but the main objective of the giving tax exemption was encourage the investors in the particular identified industries. If it is so, then again the question, what's the, say the investors come to Sri Lanka and they make profit and they take it away from their countries. What type of benefits country gets through this type of investment? If the government is not receiving any taxes by giving the tax holidays, but the investor make a huge profit and they take away that profit by way of dividend. No, but still there are benefit for the country. See the once the apparel, say that they take the one apparel export comes to the country, only he had to procure some material from the country itself. Though they import main material from outside the country, all other indirect material are procured or purchased from the within Sri Lanka, especially packing material, printing, labeling, and all their local produce. Especially once they start the construction of building, all the local material are used. And also when the factories started, lot of labor requirements are there. All the skilled and unskilled labor are taken for the manufacturing process, and thereby through this type of tax, giving that type of encouragement, employment opportunity must be created. But once the lot of foreign companies invest in Sri Lanka and started factories, lot of job opportunities were created. That was solution for the unemployment. Lot of professionals were engaged in that type of big companies. That also through these tax exemptions, when the investors come to Sri Lanka, they create more employment opportunity for the citizens of this country. Not only that, through that investment, they bring the latest technology for the country, right? Transfer of technology also come through the investment. So everything's happened since the taxation is granted under the BOI law or the Inland Act. If it is so, if someone asks why taxations are granted by the government, the simple answer is, though the government is foregone tax, some tax revenue, giving tax exemptions and the tax holidays, but still government takes some advantages like creating additional employment opportunities and also the make market for the local products and services, especially if you take the providing of security. All the security services are provided in locally. They have not bought the security from their country. They procure in that type of services locally. All the factories are providing free meals for their employees. They all purchase for the meals from within the country. There are some, for each factory, there are registered meal suppliers. They also get the benefit through this type tax exemption. Through the tax exemption, a lot of investors come to the country, and thereby they help to formation of our capital of this country. See, though the initial stage, the tax exemptions are granted for certain periods. When the tax holiday of the exemption period expired, they have to start to pay taxes. And also, they dispose some item for the local market. Then, for that local market, they have to pay all the direct and indirect taxes. Our port also had to be, port operation also had to be wide or expanded. Why? Once the exports are involved, we need the big port. The port operators, likewise the shipping industry and the shipping agency, the service providers for the ships, all the industries were benefited through this tax incentives. Especially in the foreign direct investors came to Sri Lanka and therefore the objective of tax interest is not only for the capital formation of the country, but giving more capital, bringing the latest technology. That means that technology transfer, the quality of products for the country. During the 1917, once the GCC, Great Economic Zone, was established, the big investment came from the Singapore, the Prima Ceylon Limited. They invested heavily in the ply industry. Now in Sri Lanka, we all have the quality ply products. Through this investment, they brought the latest technology and they processed they started the ply mill and they provided the particular plows to the government and the public, private sector. Now all in Sri Lankans, we have opportunity to consume the quality ply. Why? Before the Prima invest in Sri Lanka under the agreement reached with the BOI, Food Commissioner imported all the ply requirements. During that period, in Sri Lankan experience, Sri Lankan couldn't consume the quality ply products. But once such a company like Prima, they brought the latest technology and they started a big mill in the Trincomalee and they started the ply mill and they produce quality products. And that way, like that, there are some direct and indirect benefits to the tax exemptions. In Sri Lanka, as I said, up to 2016, BOI and Inland Act both under the BOI and the Inland Act gave the tax incentives and tax exemption. Now BOI is no more giving the tax exemption, only they are providing other facilities. Now only under the Inland Act, taxpayer can get that tax benefit, claim the tax exemptions. Right. The tax exemptions. That normally, once the country implement the tax system, the government, under the respective acts in Sri Lankan context, Inland Acts specify some rates for the taxation. For in case of individual, in progressive, starting 4% up to 24% of the high income is tax. But in corporate, the standard rate is 28. And there are some other higher rates of 40% of is tax applied for the profit of the tobacco, alcohol and gaming industry. Any profit made by that type of corporates, their profit is taxed at the rate of 28. In addition to that, in some business profit is taxed at rate of 10%, and some rates are 12%, and some profit have been exempted. That means, and also with the government give some tax incentive to some expenditure. Once say in when we compute the adjusted business profit to the corporates, we allowed the capital allowances. Now in some cases 50% of capital allowance is granted. In some cases in Sri Lanka now 100% is allowed. That means if any capital asset is purchased, 100% is capital allowance allowed, means they can get the full, they can then thereby they can reduce the adjusted profit, and thereby they can reduce their tax liability. If therefore in the global context, we identify that is the accelerated capital allowance or the accelerated investment tax allowances. And likewise, the tax extensions or the tax reliefs are granted by several ways. One is through the capital allowances or the investment tax allowances. Under the Inland Act, Section 34(2)(s), once any company made any new undertaking or they made some expansion, they were entitled to claim the investment tax allowance as qualifying payments. That was restricted to 25% of the assessable income, but anyway for the period of 4 years they would have claimed. And also in some cases they were entitled for the capital allowance, accelerated investment tax, and also the tax exemption. Likewise, through the expenditure claim also the tax exemption can be given. Any measures that may be introduced by the Taxing Act to reduce the tax liability of the persons, and those are we call the tax incentives or the tax benefit. In Sri Lankan context, if we treat the Inland Act within the expenditure framework, also tax exemption or tax reliefs were, especially in the investment tax allowances and the capital allowance. If the capital allowance of 50% is allowed, means they are getting more benefit. If the amount is 100%, the capital allowance means they are getting full. Even capital expenditure also they can claim as expenditure, and thereby they can reduce their taxable profit and they can save more profit for the investments. Right. Each and every budget is presented by the Minister of Finance to the Parliament. Always before the budget, the lobby group asking tax exemption or the incentives. Consider the requirement of the country, Minister of Finance or as a politician, they say come decision. Once the war is over, the government had wanted to develop the north and east. Lot of investors reluctant to go to the invest in those areas. It was very difficult. Even professionals also reluctant to go there. But there were a lot of people were unemployed. Resources were there, but no investors. Then governments, Minister of Finance announced in one budget, you invest in lagging area, that means undeveloped area, especially in the north and east. You relocate your industry in that area. That means you make new investment. Considering all those facts, government gave some tax incentives or the tax holiday, period of tax holidays. Likewise, that type of things we call criteria for the investment. Sometimes government say this is the minimum amount of investment, less than 100 million or 500 million, and also the government specified the area of investments. Likewise, government same time describe the investment criteria, government identify the particular industries and areas to get the tax exemption. The investor or the taxpayer must fulfill all those requirements. Consider the amount of investment. The government grant the depend the tax holiday period. In very recent budget, one example, in some cases, the investment is investment information technology. The investment amount is not less than 50 million, but less than 100 million. The tax exemption period is 4 years. But the investment is 200 million, less than 200 million, but exceed 100 million, the investor can get the taxation for the period of 5 years. But the investment of more than 200 million, he can get the taxation for a period of 6 years, depending on the amount of investment. That is that type of things we call the investment criteria, right? Likewise, the taxation are granted considering the fulfillment of the fulfillment of the criteria specified by the relevant taxing statute. Right. As I said, in GCCs and Board of Investment of Sri Lanka, especially the government promotion arm, always invite foreign investors to come and invest in Sri Lanka. And they announced that if anyone comes to Sri Lanka, we provide necessary infrastructure facilities. The government allocated some lands for some specified area. While in first stage, government only period zones were established in the Katunayaka. Then, lot of investors came. Then again, once the investors came more, start to come more and more. Viyagama, another investor zone was established. Then, lot of investors went to the Viyagama. Then government had wanted to invite more and more foreign investors. Then Koggala, Pallekale, Polgahavala, Sitavaka, Mirigama, likewise the government under the BOI, lot of industrial zones were open and foreign investors were invited and they invested. Right? Now, the taxing, now this is a good area for the research for the master level students. The government, right, government foregone some, once under the BOI exemptions were under the companies invested in Sri Lanka, especially foreign companies, they invested, they made huge profit, but they didn't pay any taxes. That means, say one company made 1,000 million, but standard rate is 28, 40, 30%. But since they enjoy the tax benefit, they are not paying taxes of 30%. If the profit is tax rate is 30%, the profit 1,000 million, that means they are saving 300 million of 300 million as savings. Then one can make a research. The BOI, lot of criteria were introduced for the investment. Whether the BOI, FDI came to Sri Lanka is effect to the government capital formation. What is the effect of FDI for Sri Lankan capital formation? Under what extent they form their capital in Sri Lanka? What type of capital they brought to Sri Lanka? And the effect, again we can measure what are the number of employment opportunities they created, and also effect can be created what type of latest technology they brought to the Sri Lanka. In other areas, what is the volume of export what is the volume export they have done through this export processing zones. And also one can argue that no, that benefit is not enough to meet the revenue foregone by the government. If the government, the revenue foregone is say the 50 billion, but the benefit is not up to the extent of 50 billion. That means FDI is not affected to Sri Lankan develop as expected by the policy makers, and therefore always effect of the FDI should be measured by time to time. We can again say they has no they all the material they bring from the outside the country, always the skilled labor also they bring their country, expertise also bring their country. Only very few locals were employed. They are not know any value addition for the local product or services. They know any benefit for the country. Only pay that is for their they locate only for their benefit, not for the country's benefit. Each tax incentives the investments. The investor also get the benefit in other side. Both government also get the benefit. In both parties should get the benefit. That is the rationale of the tax incentive. Investors also get the benefit. Otherwise, they won't come to the industry in other countries. The FDI is the new subject for the world, and this is discussed in the global context. Foreign direct invest. Even America also are asking the come to their country and invest. In Japan also ask, in China asking. All the countries of the globe request foreign investors come to their country and invest and contribute their economy. Why? For that purpose, all the countries offering lot of benefit, not only through the income tax, even custom facilities are given, export duties are relaxed, and also the pre-lands are, especially in India, the pre-lands are provided for the manufacturers. Under the low cost electricity is provided, lot of rebates, and the subsidies are given to increase the foreign direct investment. All the tax insurance one must learn about the FDI. Why FDI? Through the FDI, government revenues are foregone, the government losing, and also the government giving tax exemptions, tax holidays, and therefore government also has some expenditure. Once the tax expenditure, tax exemptions are given through the tax holiday or the reduced rates, government lost some revenue, and that is because the government have to forego some tax revenue. Right. Other thing is the misuse of tax exemptions. We learn that subject also. Once the tax exemptions are granted by the 11 Act, lot of people are misusing that type of tax exemption. In Sri Lanka, there is very good court case. The case went to the up to the court of law. The one wire manufacturer, they invest some amounts for the industrial expansion. The government give the tax exemption only for the investment in industries of industrial tool manufacturing and industrial tool manufacturing. Anyone invest more than the amount, the given amounts, invest in the industrial tool manufacturing, they were entitled to claim the tax exemption for the profit made through that business. One wire manufacturer of this country, two wire manufacturers of this country, they also manufactured fire guard wires and made the profits and claimed the exemption, saying that this is industrial tools and therefore they also entitled for the exemption. Case argued, but department was not accepted the position of this person. Now the policymakers or the tax administration had to decide whether the product of fireguard wire falls to the definition of industrial tools. Right. Industrial tools. The department in initial stage that was not accepted and said wire are not the industrial tools and thereby right. The taxpayer claimed the taxation for the profit. The department officers did not accept the position and they rejected the return and disregard the taxation were demand the taxes. The taxpayer appealed for the assessment and the appeal went to the tax appeal commission and the board those days tax appeal commission. Tax appeal took the position that fire guard wire does not fall to the definition of the industrial tools and thereby tax appeal commission also confirmed the assessment. Tax appeal commission also confirmed the assessment. Then taxpayer disagreed with the tax appeal commission decision and they requested for the tax appeal commission state the case whether decision of the tax appeal commission error in question of law and asked for the opinion of the court of appeal and thereby tax appeal commission state case to the court of appeal. The court of appeal heard the appeal and they decided that the fire guard wires does not fall to the definition of the industrial tool. But you see how since the word is misused by the investors and thereby in Sri Lankan court there are so many appeals under the inland before the tax appeal commission and the courts. Why the taxpayers define one way of the words of the acts and taxing authorities, the officers also define in other way. There are dispute. This is not related in Sri Lankan court. Is in global context. Tax exemptions are misused by the investors and they are claiming undue. But in some cases, once the case is not so clear, there is an opportunity for the argument, and therefore we must see once the tax exemptions are given, in some cases tax exemptions are misused and they get the undue benefits. In Sri Lanka, there is other case law reference only for our students' general knowledge. In Sri Lanka, as the capital market developments of this country, the government and as a policy matter, they had wanted to encourage the mutual fund and the trust fund in venture capital businesses. The tax exemptions were given for the venture capital businesses. Venture capital means they are investing in risk undertaking under Section 22 on that Act under Section 2000, 11 Act number 2000. Tax exemptions were given for the venture capital company. To get the tax exemption, they should the basic requirement was they should invest in the risk undertaking. But the particular the venture capital business, they invested in the risk undertaking, and also they had some excess funds. They invest in treasury bills and they receive the interest income. Then the company, once the profit is ascertained, they go to the inland. We all know now, we have studied the under the Inland Act section 3 recognize and identify some source of income. Section 3A, we identify the profit from trade, business, profession or vocation. Section 2 employment income, and 3 we identified the under section 3 C, we have the annual value and also the dividend, interest and discount. Then say the particular company, the venture capital business, they had two sources of income. One is business profit from the venture capital. In addition to that, the venture capital business receives some interest on the investment in treasury bills and the bonds. Then the venture capital business, in their account, they recognize as a was interest also part of the business income. They only ascertain the business income and they claim the exemption. Right? Then the department officers, when they scrutinized the accounts, they found that the company had the business profit as well as the interest income. The officers' opinion was the company had two sources of income. One is the business profit for the venture capital, other one is the interest on the treasury bill. They thought, the department of opinion that you have the two sources of income. One is business profit, business income. The return of the business income and the business profit. Business profit is exempted under Inland Act since you are engaged in the venture capital business, but exemptions were not given for the venture capital interest income, and therefore department formed the opinion that interest income is liable for taxes. Why? The name of the company was Lanka Ventures Limited versus case is Lanka Ventures Limited versus CGIR. Lanka Ventures is the one subsidiary company of the investment one investment bank of the DFCC, Development Finance Corporation of Sri Lanka, Ceylon. Right? The Lanka Ventures Limited, that is now that case, that is a decided case. In that case, then in the Commissioner General stage, the appeal is heard. Then Commissioner said, you get the 10% of expenditure against interest income, and he also confirmed as the separate source, but still he allowed the 10% as expenditure. But they were not satisfied with the Commissioner decision and they appealed for the those days Board of Review. Under the very simple, only the general knowledge of the officers, students of this class, then I little brief the appeal procedure. If any assessment is made by a taxation officer, if that taxpayer is not agree or satisfied with the assessment, they can make an appeal to the Commissioner General. They must make an appeal to the Commissioner General within 30 days. There are some specified criteria for the appeal, but we say once the genuine appeal is made by a taxpayer against the assessment, then Commissioner General must assign one other officer to settle the appeal. That means the relevant officer should come for an agreement with the taxpayer to settle the appeal. For that purpose, one officer should again call the taxpayer and discuss the matter in all, and they can reach an agreement for the settle the appeal. Accordingly, appeal can be settled. Sometimes assessor can reduce the assessment or confirm, or sometimes assessor can cancel the assessment after reviewing the all the ground of appeal. Say there no any agreement with the officers of the officers with the department, then Commissioner General shall hear the appeal again. Whether the first officer has not correctly considered the facts, and he should fix a place and time to hear the appeal, and therefore for the higher officers of the tax department assigned to hear the appeal. On that stage, the Lanka Ventures case, one commissioner heard the appeal and he allowed 10% in expenditure against the interest income and confirmed the assessment, saying that interest income is separate source and that that part is not entitled for the tax exemption. Then I am talking about the how the corporate are misusing or the misinterpretation or misunderstand of the exemption provision. The case went to the board of it. In that type of days, if any taxpayer, once the taxpayer make an appeal to the commissioner, he becomes the appellant. That is the term we use for the taxpayer. On that is you name is as the appellant, the abhyachaka. Then he can make an appeal to the those appeal mechanism board of review, third district board of review. That board of review members were appointed by the Minister of Finance. That board heard the appeal and board also decided interest income is separate source and that part is not liable for that part is liable to income tax. Only business profit on the venture capital is exempted. On that basis, exemptions are disallowed for the interest income. The part, but board of review also did not disturb the Commissioner General decision allowing 10% of expenditure against the interest income according to section 25(3) of the Act of the Inland Act. No any expenditures is allowed against the interest income. Interest income is the full amount receivable. But when the Commissioner has taken a decision, the board of review did not disturb the Commissioner decision. They only confer the assessment. The taxpayer went to the Court of Appeal. Court of Appeal also heard the appeal of the Lanka Ventures and decide whether interest income is separate source and liable to tax and whether profit derived from the venture capital is exempted. The Court of Appeal consider all the fact. They listen to both parties. For the appellant, some counsellors appeared. For the department, solicitors of the Attorney General departments were appeared, and case was argued. The court, after listening to both parties, the Court of Appeal decided that what is the rationale behind giving tax sections for the venture capital industries, venture capital investment. They found that venture capital industry invest in the risk undertaking, and since they invest in risk undertaking, their profitability is uncertain. Whether they can make a profit or loss is uncertain, but still they invest in risk undertaking, and therefore if you make a profit you can get the exemption. With your loss you have to compensate the loss. Once the taxpayer get the risk and also help the investment in this country, they gave the tax exemption. But same time court delivered that investing in treasury bond are the low risk investment, and therefore the policymaker had not wanted to give any tax incentives or the tax relief for the low risk investment like treasury bill and treasury bonds. The return in the interest that is a separate source and therefore liable. And accordingly, the court also decided that any profit derived from the venture capital that is undertaking, investment is under the profit derived from the risk undertaking is exempted, but any return received for the as interest on the savings deposit in treasury bill and bonds and the banks are liable to tax. Why? This is low risk interest, but the Court of Appeal also did not disturb the Commissioner General decision, allowing the 10% of the expenditure, though the Act does not permit to allow any expenditure against the interest income. That is also one decision of the Court of Appeal in case of tax exemption. Right. Right. Now we must little talk about the policy aspect of the tax exemption. As a tax administrators, we now we understand how what is the tax exemption, tax incentives and all. I will give you all the details of the tax incentives and the tax exemption given by the granted by the Illinois Act. Then you can easily understand what are the tax incentives there, tax holidays and all very, you can read anyone. But we must, as this type of level students, we must little learn the policy aspect of the what is the literature involved for this subject and how it is recognized in the global context and the policy aspects. As I explained, when the tax exemption is given, the government has to forgo some tax revenue. Or the lower rate is introduced, up to some extent tax, the government is losing some tax. If the tax holidays were given for a 10 years period, any single cents come to the government, though they are making billions of profits. That means we are foregone some, we are losing some tax revenue. In the global context, if any tax authorities given tax incentives or tax exemptions, that means they are pocketing some tax revenue and they are losing some tax revenue. In the economic context and public policy, the fiscal policy context, we call that is the tax expenditure. But you can't see in government context, one they say the one all the person of this country, if one make any profits, they are liable to pay taxes under the rate of 10% of the given rates. All have to pay taxes. Say, but say the government, while imposing taxes for all the sectors of the country, the government collects, say, the introducing rate of 20% of tax, government collect 200 billion of tax. The next year, government takes policy decision. No, we reduce the rate of 10%. Then government knows definite if the existing the same level income is maintained by taxpayers, their revenue will be 100 million. Why? They know the same level income is maintained by taxpayers. Since the rate is reduced to 10% from the 20, the tax revenue will be reduced from 200 billion to 100 million. Now we can with the what is the loss of the common revenue. That's the taxes from 20 to 10, that is the 100 million. Now in the policy aspect, we call it that is a tax expenditure. In the very simple example, we say the same, all the people of this country pay the taxes to the government, and once the government was impose the rate of 20, government collect the 200 million revenue. The next year, government reduced the rate to 10. The real income was maintained by all the person of this country and paid the 100 million of tax. Then government expenditure was 100 million. On that basis, tax expenditure is computed. Then in global context, that all the tax authorities is the world and the policy makers on this subject, they always consider the tax exemptions and the tax incentives. Then they always consider any policy aspect related to tax incentives or the tax holiday or any reduction of the taxes or any relief given under the tax statute. What is the expenditure in simple context? What is the revenue via the government in losing? What is the revenue foregone by the government? And therefore, that is more important than no one should not go fear about once the word of tax expenditure used by the policymakers, then we must know what is the revenue foregone by the government through the tax expenses and the reducing rates or the any other tax relief given by the government. See, the tax expenditure is very simply defined. The tax expenditure is the departure from the normal tax code that lower of the taxpayer's burden. For the example and exemptions or the deduction of the credit, they are called the tax expenditure because in the practice they resemble the government spending. Right there, the simple terms I explained it. The most obvious kind of tax expenditure is the provision that directly lower tax burden for the subject taxpayers engaging in specific activity. The lower tax. In Sri Lanka also, we all know that tax expenditure can be, as I said, say the presumption is all the income is taxed in same rates. But once the policy maker need to give some tax relief, having in other objective to be reached, if they forego some tax revenue by way of giving some reducing rates or the exemption or other kind of tax relief, then we call that is the tax expenditure. Even giving qualifying payment, the government foregone some tax expenditure, especially in the investment tax allowances was granted from as a qualified payment from 11, 12 up to 15 and 16. Government foregone very big tax revenue, that is the tax expenditure, and therefore each tax authorities of the globe, they compute what is the tax expenditure of their country. Especially America started to compute the tax expenditure. When we talk about the taxation under master level, we must learn the tax expenditure of the tax administration or the policy makers, and therefore policy makers always budget the if any policy matters introduced as a taxation or tax holiday by foregoing some tax revenue, they must quantify the amount of tax expenditure, and therefore if it is so, if in present context of the Sri Lanka, there is a big argument in the past 10 years of the of government revenue was decreasing. Especially they compare with the GDP, tax GDP to the tax GDP regularly decreasing now. From early we in Sri Lanka had the tax GDP ratio of more than 17%, and now reducing less than 10. Then that scenario, there is big argument. The government is reducing its tax GDP. That is the reflection of the poor tax administration, and the blame must go on to the policy. The blame should be gone to both tax policy makers and also the tax administration. If any effect to reduce the tax GDP, the result of the tax administration, that means the administration's efficiency, that must be gone to the tax administration, that is the implementation tax department, and also the officers must take the responsibility. But the Commissioner General or the tax officers do not have any power to give some tax exemption or the tax holidays, but not by the Indian Revenue Act. Even BUI also gave the tax exemption, and thereby in Sri Lankan tax expenditure is computed for the past few years. We must compute what is the tax amount we lose through the BUI exemption and the inland tax exemptions, and therefore the reducing the GDP to the tax GDP is one reason is the tax expenditure. If the tax expenditure is more and more, the government revenue is going down, if the government can maintain the tax expenditures very low level, the government can get the more tax revenue. That means in simple terms, if the government can remove remove more, remove some tax exemption or not giving tax exemption in future, government collect more taxes. That means government more concerned about the giving, reduce the tax expenditure. But for that purpose, again the policy level, that type of research must be done. What is the taxes? And the CC, if someone can very easily compute the, if someone can make a research, what is the tax expenditure in all of the past 5 years, the 10 years, and if you correct quantified, then he can easily compute the what is the GDP involvement of this. If you say if any 1% of reduction of GDP involve the tax revenue of 50 billion, then if someone is computed our tax expenditure for the year is 50 billion, that means the 1% reduction is due to the tax expenditure or that means the tax exemption or the reduced tax rates or the any kind of tax incentives, and therefore that is a big other area for the research, tax expenditure for the master level students. Then again, if someone is doing that type of research, they must find what are the limitations and obstacles against that type of research. However, measurement of the expenditure can often be more complicated than the clear-cut example about what one is considered to be the tax expenditure. Likewise, if you read this my Word document, you can get some idea for the tax expenditure. The US has both an individual income tax and corporate income tax. Therefore, there are both individual corporate tax expenditures. See the areas. Even say that even we are taxed in Sri Lanka, we are past few years employment income was, though our standard taxes for the individual was 24%, but the employment income was taxed at higher rate of 16%, for 16 and up to 15 and 16. Some professionals were taxed only the rate of up to the rate of 16%, and some government employees tax slabs were their exemption level of 750,000. Also now it is increased to 1.2 million. The 500,000 was threshold, but especially the again 600,000 of motor vehicle allowances was given for the pay tax purpose in the government sector and the private sector. And that purpose their threshold was 1.2 million. Then on that basis, that also goes to the tax expenditure, and giving that type of tax foregoing taxation for the individual taxation, especially in the employee income taxation. The employment income means the labor. As you all know, in this subject you must know, as in the case theory, we have learned some in the land, labor, investment, like that way, the production factors, for factors of production, the employment income is the return of the labor. The business profits is the investments. We call the Vyavasaya investors. Other one is the capital. The investment return is the interest. From labor, we compute the employment income. In capital, we get the interest. In other areas are the dividend, and also the in land we get the rent income, land and improvements. Likewise, production factors, according to the production factors, the return is we assess as income for the each sector. That type of things also must be learned in this level. If someone knows what is the return for the labor, how your labor taxes in this, as small, sometimes people, sometimes some some may can get frightened. He can ask in Sri Lanka what is the labor taxation? Normally we feel the laborers are the people who are spending their energy, spending in they are hard working people, but that is not the labor in the economic context. If any people is performing their duties and getting, if any, the human capital performing their duties and getting something, the performance process is we call the labor. The availability of the human resources. If the labor is employed, then there must be some return. That is we call the employee income. The employment income must be if the labor paid the daily fee. In corporate pay the salaries. In some cases they are paying service fee. That can be reduced. Some say the profit share. Some case it is a bonus, incentive, but by several means that can be paid. But all the other return for the labor. Likewise, the US has both individual income tax and the corporate income tax. Therefore, there are both individual and corporate tax expenditure. The individual income is the larger tax, and the it has the larger tax expenditure. Say the countries like America, they are in Sri Lanka, 70% of the more than 70% of the income tax revenue comes from the corporate tax sector, but very few. But in US, more than the large amount comes from the individual taxation, for the payroll taxes and all. The individual, again, in Sri Lanka we learn only the pay taxes, and in other countries there are some payroll taxes also. Payroll taxes we must earn. I have some little idea about the payroll taxes. Payroll taxes is also, but I only for general knowledge I like to highlight that in lot of countries they implement the payroll taxes. In Sri Lanka, if take the very large business corporate, they pay taxes are deducted only if their payment of the salary for the year is exceed 1.2 million in the present context. But say there are so many employees, they are receiving salary less than that amount. That means that no pay taxes are deducted for some salaries. For that purpose, if any amount of salary is not attracted with any pay taxes, the employer has to pay some taxes on behalf of them. Say the 400 million of salary bill of this the big corporate, only 200 million payments involve the executives and deduct the pay taxes. Balance 200 million was not subjected to they have paid small labor. The laborers and also not the executives and the below level executive level employees. Then their salary pay has been deducted. The amount that has involved for the not deducted pay was 200 million. On that part, some countries impose the payroll taxes. Right? The payroll taxes are, then payroll taxes is imposed not to the employee, that is the employer. Once the pay taxes is deducted from the employee salary and he was given the balance, only corporate are collected. They are deducting and submitting in the tax department. But the payroll tax burden goes to the employer. That is also one must learn, and therefore you must have little knowledge of the payroll taxes, also the one labor part of the labor taxation, the employment income taxation. Any amount is not subject to pay taxes. The tax deduction by the employer must pay some taxes for that amount of payment of salaries or the laborers. Then you can see the brief history of how the tax expenditure, then this global context. This subject is taught in the OECD countries and the United Nations, and the higher tax, all the tax forums on the globe are discussing with the tax subject of tax expenditure. But all the government must compute before they make any tax exemptions or tax incentives effective to the government revenue. That means before any they must forecast the and the budget the tax expenditure of the any policy instruction of the affected the government revenue. Right, on that way you all can learn this wise. I have I extracted some this upon some research papers and I have given some see the you can again get the clear idea for the tax expenditure, how the UK government, US government has budgeted, on what basis they are, see, they are contributing tax, they are exclusion from the income employment based health insurance, tax GD 1.5 to 1.T. See, only for the employment based healthcare insurance. See, in Sri Lanka, one can compute easily what is the effects for the giving the tax exemption for the motor vehicle benefits. But that not be very big, but there are some impacts and also reduction of rates and all. One can easily compute, say that in Sri Lanka, our tax revenue is goes to more than 500 million. Say that if the 100 million is, 50 million is involved for the tax expenditure, tax expenditure, all the forward revenue is that the tax expenditure goes to 1% for the GDP. There is good research for the mass level. So the even one can prepare the research paper for the tax expenditure, be good subject for the mass level. If since you all are studying the subject of taxation, even tax rules very easily applied by the. Then in this classroom we learn much of tax rule to compute the taxable income. Like anyone can easily, there is a computation method, that is all the accounting and statistics are involved, but these are some clear subject for the policy levels. See, all the in this country, the CBO projected that the Central Budget Office projected that the top 10 largest tax manager would average 6 to 2% of the GDP. Like that is a big subject to discuss. Then in nutshell, now I am going to tell you these are the main tax expenditure. Total parcel of temporary exemption, reduced rates, deduction, tax write-off, tax allowance of taxes allowance, presumptive taxation, particular region with the pre-trade zones, tax holidays. Like there are some tax in Sri Lanka, tax holidays, tax intensive, investment tax allowance, capital allowances, reduced tax rates. Those are the tax expenditure goals, and also the individual taxation, reducing tax rates, reducing tax slabs, and also the healthcare sector exemptions like that we can take. Right? This is only for general knowledge. You can read all those, then you can get more idea and you can get more knowledge. See, on this document you can see the type of the tax incentives and taxation under the Inland Revenue Act administered by the Department of Inland Revenue. In this schedule you can see the type of industry. The agriculture, agro-processing, industrial and machine tool manufacturing, information technology, electronic and export of non-traditional products. See, here the industry is not identify the traditional products. So only the government need to encourage the non-traditional exporters. If all value-added exporters are given the concession, that say the same industry, the export of tea, black tea in bulk, profit derived from the export of black tea in bulk is not exempted. They have to pay the tax at the normal rate. But any packeted tea is exported, the reducing rate of 12 is applied. Why? That is that has been identified as the non-traditional. The crepe rubber exports is not is a traditional. But if any value-added products are, any other rubber products are exported, then this is a value-added products and that is a non-traditional and they can get the reduced rate for export. Right? For in this tax exemption criteria for quality, start of new business. Here, not the existing businesses. These are the criteria measurement. The type of the 3A exemption, minimum investment. Minimum investment, in this case, not specified. The Illinois Act number 10 of 2002. See, as I said, each and everywhere for the policymakers include some tax exemptions. As I said, in the context of tax expenditure, this type of exemptions introduced. The policymakers should have compute the tax expenditure. For how many people taxpayers will invest in this industry and what is the amount of estimated profit derived for this industry, and if that profit is taxed, what is the tax the taxes that will be paid on that tax amount should be have been budgeted. The other designated project, the designated project has been gazetted by the minister. New project 3 year. They see they are you can now you can get the idea of the here new project 3 action. The investment criteria is 500 million. See now we have the different type of see the here this is only for a new undertaking. Investment criteria is 2.5 million. What is the amount? These are the manipulation. The policymakers also manipulate the tax expenses. Say 2.5 million. What type of investment can be done through the 2.5 million? Lot of revenue was spoken under this one. Only for a 3-4% in this country was involved and they introduced this one without analyzing the revenue program of this one, the tax expenditure. This type of expenditure, after 2.5 million, what type of capital formation that can be expected by government? That the normal, even exist in the business, that type of investment, even small manufacturing business, each and everywhere, they have to meet this type of investment for the survive in the industry, replace the business and all. Right? We must in this level reading this type of schedule you can get the idea. See the this year designated for new undertaking by new company. Here the new undertaking by the new company. Therefore the new company must be undertaken new undertaking. Right? In some cases the existing undertaking can start the new undertaking. Right? Lot of apparel companies they started new undertaking. They put some other factory in other area, but one business is existing. Here the 215 is still 3 million. But here infrastructure development commence to make profit later than 6 to 2 years tax section 100 million minimum less amounts. Here 62 years. The more importance of the development, the amount of taxes paid disease can be increased. Right? Likewise, research and development investment too. That is good. That type of companies are not in Sri Lanka. There is no research and development companies. If 1 or 2 companies came even, less amount of profit is they derived very less amount of revenue is spoken, but very less amount of investment criteria was given. Right? There are no any revenue spoken. The investment amount is less than only for research and development. We don't know what type of benefit they receive during the research and developments. We don't know the success depend, the profitability depends on the research or development is success. Right? Right? We have analyzed this type up to 2005 years, not specified. Right? If someone is need to analyze the tax expenditure of the past 10 years, you can get a clear idea for what this type of expenditure were only for these are the tax exemption under the Illinois Act. In addition to that, this period, what are the tax holiday or the exemption given by the BUI? BUI also given the same type of taxation. You can get there, that criteria, they are gazettes. BUI also the gazette is the qualifying criteria. They also are given like that schedule, and also the period of exemption, and also the investment criteria. On that way you can prepare the, and thereby the profitability can be computed for the profitability of the all the exemption pay companies can be taken and apply the average rates, and average we can say one company made 100 million profit and claim the exemption. If the standard rate is applied, they have to pay 28 million. Revenue program is 28, that is the taxability is 28. Likewise, all the amounts of the to be added together, and accordingly we can compute the tax expenditure. Right? We will I stop for the little short break and start with the 15 minutes. Thanks. ඒක යන්න බමුත් එක ලබන්න. අපි දැන් ආවේ. Right, let us start. Now you can see the tax exemption given under the 11th Act for the past periods. In this schedule, always the period of taxation depends on the amount of investment, the importance for the particular industry or the service for the government development plans and all the in some cases, the one criteria is not the amount of investment. Some employment opportunities must be create a particular amount of employees, and also even here employment opportunities are not given on that way. Now we see other document. Very clearly you can see these are the one other document I have prepared for this one. You can get you can read. Now we know in this subject today we learn what is the tax expenditure. For that purpose, if someone need to compute the amount of tax expenditure and the effect to the GDP, impact of the taxes is the impact to the revenue, amount of revenue and also the tax GDP. On that basis, if someone has need to analyze, these are the areas to be taken into accounts. Right? Here, domestic and foreign source, especially in the foreign trade in securities, other exempt business income, see section 13, you can, if you read some section 13, now that is gone to the Z, A, B, C, D, double D, triple D, 4 Ds, D, E goes, and now it is go to Z. All these goes to the exemption, so the reducing rates. All, if someone in Sri Lankan context, if someone need to analyze the tax expenditure amount, all these areas to be analyzed. These are the direct tax holidays and the exemption. These are the reduced rate. Based on the income following specified tax holiday, the rate of 5 for the first and 10 for the second. There are some, in some cases, even tax holiday period is over, government change. The first year they have to pay 5% tax. Second year 10, like that way. After expiring even, lot of tax expenditure were given. If someone need to analyze what is the revenue impact of this, only this particular particular policy decision, he can compute the impacts on this one. These are the reduced rates of export and foreign currency related income. Right, this is one document and so reduce tax rates. This to be, when someone is analyzed, corporate sector as individual sector also must be analyzed. See as I say, R&D and current capital expenditure. R&D 200 is for all expenditure including the capital. Other one is a 200% deduction for all. Now it has been increased 300%. This is also involvement. Say that one company made 300 million of profits, say, but in the same year, company has invested only for 100 million of. The company has made the profit of, say, the 300 million, and say that no, the company has made, after spending 100 million on capital research expenditure, company made 200 million of profit. That is their normal business profit according to the accepted financial commercial principle of the commercial accountancy. If the deduction of 100 million is deducted as a expenditure, but the tax law says you reduce the 3 times, then 200 million is profit, again he reduced the 200 million, no any taxable incomes come. Why? They are, since he is entitled to claim the 300%. If any company made 200 million of profit after spending 100 million of research expenditure, he need not to pay tax for the 200 million. Why? He is entitled to get another 200 million as R&D, since the company is allowed 300 million, 300%. That means if a company spend 100 million of, say the research and development expenditure and made a 200 million profit, he need not to pay taxes. Why? He is entitled to claim the 300%. Then on that way, big revenue expenditure, but this is as a policy decision, and in the global context, R&D must be facilitated. The R&D is a big subject to the corporate taxation and from the global context. The R&D, the effect R&D, through the R&D also government tax expenditure is involved, but this is as a policy matter. All the tax administrators in the globe have accepted the R&D. R&D must be facilitated, or not only through the taxation system, even banking system, even in Sri Lanka, even research and developments are encouraged through the industrial and research institution. They are also facilitation. Government also giving some loans. Government recognize the persons who engage in the particular research and development. In that way, this is even the World Trade Organization gets general agreement trade and services always promote the research and development. If any research and developer finds a new innovation of the findings, they can patent it, and others are not able to follow that for 15 years. Likewise, the GATS also recognize the R&D, and if new findings can be patents and others cannot be followed as the coffee did. And like that way, the tax expenditure are through the qualifying payments, as the explained the third part too, in Sri Lankan context, we forgone a lot of revenue. Exempt payments, cooperatives and all. See, one area has to be research. Profit from any person from participation of competitors. All these are exemptions is specified in the our taxing. Say that again, sector wise, institutional wise. In some cases, other conceptual things. See the tax exemptions are given institutions. Say the Institute of Chartered Accountants of Sri Lanka, or the profit of the Bandaranaike Memorial Hall, profit of the Industrial Research Institute. Like that, institutional exemptions also given. In addition to that, the profit base, any profit derived from the particular industry, and also sector in the agriculture sector. On that base, exemptions are, or the tax incentives are got in service sector. Service sector, or likewise, there are some other sector-wise special tax rates are decided. Today is the closing session of this subject. Since all studied the subject of taxation, we must have the little general knowledge of the taxes. When we talk this subject, if we involve in the policymakers and all the other expertise, they use these type of words. See, the effective taxes. So far, in this up to this 12th lesson, we did learn the effective tax rate. These are the areas of the most important to the policymakers, and also the tax administration make new policies. We must have the general knowledge of this effective tax rates. So if you watch some television discussions regarding tax matters, the experts always talk use this type of word. They say that in Sri Lankan effective tax is very high. We say that we proudly say in Sri Lanka, in regional wise, when we compare with the region, our policymakers say our standard taxes for the corporate is very less, 28%. They proudly say in the regional less. They say in India is more than 28%. All other countries tax and more. But other people say no, you say the only for standard, but effective tax is not that. Say when the banks pay tax for their profit for apparent 28% rate, but when the profit is made, government must pay the value-added tax for their business profit. Then effective tax, when we compute the tax for the profit, that also to be computed. In addition to that, say in Sri Lanka, the deemed dividend tax was introduced. But once the dividend tax is dividend is distributed, it is deducted from the shareholder. No effect for the effective tax rate, 28%. But once the deemed dividend tax is introduced, that has to be paid by the company. But the same profit, only thing they have not distributed to the its shareholder. And therefore, in Sri Lankan context, though our tax rate is for a corporate is 28%, our effective tax rate is not the 28. Why? Since the business profit of the corporate or the finance sector is subject to the financial VAT, only that is the profit based tax that cannot be passed to the consumers, that has to be paid to the company. And also since the deemed dividend tax is involved, though the dividend is not distributed, company has to pay that type of tax. Say in Sri Lankan company, they made a profit of 100 million and paid the 20% of corporate tax of 28 million. Since the company has not distributed dividend 1/10 of the distributed profit, he has to pay other 2 million of deemed dividend tax. His total tax goes to the 30 million. Then he made 100 million, now pay 30 million. Now his effective tax is 30, not the 28. Though we are talk about the standard rate is the less, but the corporate are paying more and more. In Sri Lankan context is in finance in the bank, in finance to pay the value added tax on their profits, and that is also effective the effective tax rate, and their effective tax rate means the correct taxes that they are paid. Effective tax is normally in principle we are computing the income rate is computed. In that context, if someone is computed, the profit is in Sri Lankan context, if they are paid 25,000 corporate tax, in say they take the same example here, only for income tax rates is there, no other taxes for corporate profits. Now in the particular case, in this case, he has to pay another 200,000 of the dividend tax. Then he has to pay 28,000. Then the rate goes to 27%. On that basis, effective tax has to be computed. You always say other concept of the taxation. Once the tax rate is increased, the corporate saving or the retail saving is going less. Say that if the 28% is applied, if the 100 million profit is made, still company retain save the 72 million. If the same profit, the rate is increased to 40%, then 40% is paid for the 100 million, then he retain only the 60 million. Then he can only invest 60 million. If the companies through the taxation system make facilities to retain more profit, introducing less rates of the exemption, they can make more investment. Then again, the one research area for the students are that how corporate tax profit is affected to the corporate investment. Once the tax rate is 40% or the 50% on that period, the investments are very less. When the corporate tax rate is reduced, the company can save more money and more invest. These are the one other area. Then effective tax rate also to be compared with retail, and on that basis, and also when is any policy measures make policies introduced to tax rates, first we must compute what is the effective tax rate, not the current standard rates, and effective rates after computing, then we must make other policies for the effective tax rate. The reduced effective tax rate to be computed after careful considering all the taxes paid based on the profits, or any profit based taxes are there, all to be taken into consideration to compute the effective tax rates. See the working of effective tax. The effective tax rate simplify the comparison among companies and taxpayers. Say for individual, they are paying tax on progressive rates. The first 500,000 they pay 4%. Second, next 500,000 they apply 8%. Then for 100,000, sometimes for say that if his income is 10 million, sometimes he pays very less amount, but corporate pays higher amount, apply the standard rate. On that base, we must make some comparison. They consider the effective tax rates for the, say the for a 10 million income of individual pay only for his through his pay and all only tax paid is, say the for a 10 million, say the 10 million he paid only for 200,000, 2 million, that means he is paid only for a 20%. But all in normal taxation, 24% is the average tax rates. If we need to take the average taxes, the brackets can be wide on that basis. If the government need to collect taxes from the individual for up to the 25% of the for effective taxes, he can increase the bracket so the marginal tax rates. Then we talk about other things. What is the marginal tax rates? This also one some area when we talk in the tax. The marginal tax is the percentage of the tax applied to your income for each tax bracket in which you qualify. Say in the bracket in individual taxation, first for 400,000, 500,000 we pay the 4%. But if she has the other, say the 600,000, his marginal tax is for a next 100,000 is 8%. On that basis, marginal tax paid to be computed, and again to add in full tax and divide by the taxes from tax amount paid by the taxes divide and compare with the income, it can be again compute the marginal tax rate for the individual even. You can next to it, you can in Sri Lankan context we can put the next rupee. In Sri Lankan context, first 500,000 of the individuals are taxed as first taxable 500,000 tax at rate of 4%, second 500,000 is taxed at 8%, and so on. And therefore the marginal tax rate on computed on that base. Say that if in after the 400,000 after 3 million rupees, any single amount is earned by an individual, then its marginal tax rate is 24. Why? The average tax rate is very easily compute what average tax rate measures the tax burden, while marginal tax rate measures the impact of taxes on incentives to earn, save, invest, or spend. Right, again the repeating of this earlier one also, that we have given some little here. These are the area, this is the major area of the taxation. All the policy makers in policy level and even political arena, all the experts are talk about the tax to GDP. The success of the tax to the success of the tax administration of the tax system, one measure is the efficiency of the tax system is measured by several ways. One is what is the tax GDP ratio. That means the GDP is gross domestic product. What is the ratio for the gross domestic production? In Sri Lankan context, now it has gone below 10%. In one period in Sri Lanka, tax to GDP ratio was more than 16 and 17. Again, that tax GDP can be again divided into what is the tax GDP to the tax GDP ratio, tax income tax ratio to income tax to GDP. What is the value added tax to contribution to the, on that basis, what are the other tax contributions to the, on that basis also can be contributed. In Sri Lankan context, tax GDP is at 9%, 10%, most was more than 6 is contribution for the VAT. But if some always that is always in the global context, just GDP is the one criteria applied to measure the efficiency of the tax system. But if you get the country like Singapore, the tax GDP is very less. Still, that is the world-based tax administration. But they are different. But since the absence of their government revenue more consists not for the taxes, their businesses and all other sectors, and therefore in Singapore context, their tax GDP very less. Still, this is one of the world-based tax administrator. But see the one in Sri Lankan context, then now since the government always make lot of changes and introduce new taxes, and also the value-added tax rate was increased to 15%, value-added tax base was widened, the whole taxes for the wholesale and retail tax was introduced, the threshold was reduced 400 million to 50 million, the NBT threshold was reduced from 15 million to 12 million per annum, ESC regime also changed, 50 million threshold was introduced and 0.5 was introduced. All the measures were taken to raise the more income and thereby increase the tax GDP ratio. Government has forecasted to within next 5 years to increase it to more than 14% of the in GDP, tax GDP. On that context, government has making more reforms. If on that basis the policy has been changed. See, the tax GDP is the ratio of the tax collected compared to the national gross domestic product. Some countries aim to increase tax to GDP ratio by certain percentage to address the deficiency in their budgets. So that means they need more and more revenue. If the government need not more and more revenue, they need not to worry the increase the tax GDP, because that is not only for criteria for the measure the efficiency of the tax. Even the situation that all the taxpayers are 100% compliance and government collects some taxes, the government meet their expenditure, the government need not to increase again and again the taxes by the collecting amount is enough to meet their obligations. The some country higher tax GDP ratio, the Sweden for example had a tax GDP ratio of 35% at 2000, but Estonia on the other hand at a low of 1%. The tax GDP ratio in 2004 of the 2004 US tax GDP ratio was 11%. The person can say the compare with US. In Sri Lanka also the 2014 was 11%. In US also maintained the same percentage of GDP. We are also like US, but we can't claim that type of thing. Why? There are some other criteria for the measurement of taxes. In Sri Lankan, the tax avoidance are very high, tax evasions are very high, the tax gap is close to 40% of the tax GDP, and therefore we can't. But the US, they are maintaining their tax gap is the hidden economy is less than 10%, and therefore they can say their tax administration is very efficient, and therefore the tax GDP is they are in the acceptable and tolerable level. If any tax expenditure or the consider only they can increase only for a 12 or 13, that type of thing they can forego for a benefit of the citizen and the development process. The US, and therefore they are satisfied with their 11%, because that is the maximum they expect. Though since they have given some, they have foregone some revenue to tax expenditure and also their tax holidays and all, but still they have maintained the very good tax compliance and they reduce their tax gap and all. And therefore, if you are considering this 11% of US, you can't say that is not the only criteria for the measure the efficiency of the tax system, right? And therefore, in Sri Lankan context, according to the government estimate, according to the GDP and the economic and earning level of the countries, the consider tax gap of the country, tax hidden economy, the government can at least, the collectible tax is more than tax GDP should be more than 15%. But in the absence of the proper administration system and the policy, that tax to GDP ratio is gone don't. That is the 11%. They are policymakers as well as the administration must responsible for the lower of the tax GDP ratio in Sri Lanka. When a tax revenue grow at a slower rate than the GDP of the country, the tax GDP ratio drops. When the GDP goes faster than tax revenue, the ratio increases. These are the one, again the research areas, the faster than tax revenue, the ratio increases. For example, if a country has a 10 trillion GDP and tax revenue 2 trillion, its tax rate of GDP is 20%. If its GDP increases 15 trillion and its tax jumps to 3 billion, it's retained the 20%. See, in Canada, GDP increases 18 billion and tax rates only increase 3 million, the ratio of 7.C. On that basis, you can easily understand on what scenario the tax GDP is work as efficiency, and also in what situation the tax GDP is going in inefficient situation. See, the tax GDP ratio gives policymakers an analysis as a metric that they can use to compare tax from year to year. In most cases, taxes are related to the economic activity. The ratio should stay relatively consistent. Essentially, the GDP grows, taxes should grow as well. See, then always the one research area is always tax GDP is depend on the gross domestic production, right? If the gross production is increased, tax to GDP is increased. If the gross domestic decrease, the tax to GDP is going less. That is one area for a research, and therefore some limitation and all. On that basis, if the tax revenue is gone down and tax expenditure are more high, and thereby tax revenue GDP can go down, can go down. On that basis, considering that type of limitation, effectiveness must be ascertained or the measured. Tax behavior is also, we are other subject we talk about this subject. When the tax experts and economists, they are to use this word when the matters are involved in taxation. Therefore, we also must know general idea of the tax buoyancy. Buoyancy in Sinhala, we normally saw the Karunaava, and also like that way. The tax buoyancy is the indicator for a measure the efficient responsibility of the revenue in the response to growth in the gross domestic production national income. If the tax buoyancy is high, revenue is going up. If the tax buoyancy is going low, the tax revenue is going less. Right? If it is so, the ratio of tax buoyancy also one criteria to measure the efficiency of the tax system. And there we must have a little idea. This is also tax buoyancy is also measured in research. The other word used in the taxation. Only we learned computation method of in this year, but anyway, we as this level student, we must learn little about the tax compliance. For that tax compliance, there are many meanings have been given by the expertise and some organization. US lowest organization also given. Biases also have given some meaning for the tax compliance. But anyway, one general meaning is the tax compliance means making tax payments and producing and submitting information to tax authorities on time and in the required formats. Say here we can say the registered compliance. If the countries, all the people who must have 500,000 income subject tax have registered, that means 100% registration compliance. And also they pay due income tax in quarterly due dates. Then that means 100% payment compliance. And all the taxpayers furnish their return in due days before, that means in Sri Lankan context, before 30th November each year of assessment, that means 100% compliance. And also the other thing is they are correctly reporting their profitability and applying the correct taxes, that without any avoidance and evasion or the willful neglects. Then on that situation we say the 100% tax compliance. Then we can say the what are the impact of the, if it is so, if the tax compliance is low means that is definitely affect to the tax revenue. Say that if all the registered person, the potential taxpayers all have not been registered means they are not paying taxes. Still they have the income, they are not registered, they are not come to the tax net. That is the administration inefficiency. If the registered, the person, those who subject or the liable for the registration, that means Sri Lankan course, anyone has the taxable income of 500,000 must register with the revenue, but not registered means the tax administration has failed to register all the taxpayers. That is the, if it is so, that is the inefficiency of the tax administration, not the policy makers. All the person who must pay taxes must be in the tax net as a registered taxpayer, and if they have not in tax net, that means that is administration is inefficiency. That means registration risk is very high. That means the very high risk that must be minimized. If the 10% or the 5%, if the in Sri Lankan population account estimates that they say that if some economy estimates more than 3 million of people have exceed 500 million of income in taxes, there must be the one economic estimate in Sri Lankan population, 3 million population has the person has the 500 more than 500,000 income. Inland Revenue Department must have the 3 million of the taxpayers. If they less than that means the department has not correctly registered the potential taxpayers, and always the tax compliance is effective to reduce the tax revenue. The non-filers mean the person who has registered with the tax department but they are not filing. In some cases, there are some deporters comes from they are filing returns and they declare the report the tax liability and not paying. Some deporters come, some people are paying not paying taxes in due dates, and also and thereby they are deporting, and then that is all the one bad part of the tax compliance. If the tax compliance is very efficient, tax compliance rate must be very high. The tax compliance to be the registration compliance, reporting compliance, payments, and return furnishing. All the four parts to be compliance in 100%. Then other is the compliance cost. This is all the one topic of this subject. I have not given. I have given the reference of my Word documents. Compliance costs are the cost incurred by the taxpayer in compliance with revenue laws. Studies of private compliance costs generally find that these costs are larger than budgetary administrative costs, that they largely substitute for administrative costs, and that their incidence can be quite different from those of the tax themselves. And there are compliance costs, right? In case of corporates, for auditors, they are paying some amounts. Say, that means the audit fees. If some tax consultants involved, they have to pay the consultancy fees. If some lawyers are involved for the appealing argue, then also they have to pay some payments. Then these are the direct costs. Then, in Sri Lanka, once the taxpayer make a proper return, he must furnish the specified form, and along with this form, he must attach the financial statement, and also schedules and certificates as specified by the Commissioner General. Then finance institution were not enough to make a proper return. Then they have to prepare the schedule and certificate. For that purpose also they have to make some, they incur some expenditure. Why? The department does more and more schedule and certificate. That is effect to the cost of the taxpayer. They are producers are not preparing schedules and certificates free. They charge for that. Not even that. For that purpose, the employees of the company also involved for the preparing set of books for the preparing financial statement, and therefore administration cost also represent some cost related to the taxation, and therefore it is very difficult to correctly assess the compliance cost of the taxpayer side. In other side, in tax administration side also, some cost is included. In Sri Lankan context, if someone is interested to read the get the information of the compliance code, you can read the performance report of the inland departments, and you can get the compliance our collecting cost for the taxes each and every we have given it. For that purpose, department has salary bills and also the other administration bills, electricity, telephone, and all the top bills are involved for the maintenance of department. Higher percentage represent the department salary and the incentives, and also in addition to that we have the other expenditure, computer management, capital expenditure, all are include accordingly. In Sri Lanka still we are maintaining 1% total collection cost is less than 1% total collection. That means in Sri Lanka 500 million is collected. Our expenditure does not exceed the 5 billion. In a lot of countries spend more than 2% of their total collection for as collection cost. Every tax administration try to maintain the below 2% of the collection cost. In Sri Lanka still we are maintaining 1% of the total collection. Our compliance cost is, our collection cost is, to contrast with the tax compliance, our collection cost is below 1%. In some countries, if the compliance cost is increased, means the tax administration is very, there are some element of inefficient tax administration. If the tax laws are very complicated, lot of appeals come. That means taxpayers' compliance costs are very high. In Sri Lankan context, we have, for transparency regulation, we have issued some regulation for that purpose. Lot of compliance regulation, schedules, furnishing, and the certificate requirements. And for that purpose, company has to pay 2-3 million only for certificates, prepare that type of certificate, and therefore they have involved more and more. Right. These some other elements. We little talk about the other tests. This article I have published in the Economic Review of the People's Bank. Economic Review also you can access the same, not the same document. A lot of information are in that Economic Review also, single and English both, on the last volume of the People's Bank. In addition to that, I have prepared this document. You can read this one. Only here I am going to explain for what is the tax planning, what is the tax avoidance, and what is the tax evasion. Tax planning is the any act done by the taxpayers in order to reduce their tax bill within the scope of within the parameter of the tax provision. That means they make use the provision of the tax index. Once the tax exemption is granted, taxpayer comply with this section. Say once the government invited the people to invest in information technology for 100 million rupees and take a 4-year tax exemption. Then one gentleman establish separate company and start development, software developments, and make a profit, claim the exemption. But he planned his tax, and also the existing company, they start another new undertaking for a software developments and make a profit, claim the exemption. Then that means he planned according to that is the policymaker expect of the taxpayer. The reducing tax bill of the taxpayer make use the relevant tax expenses of the or the other relief under the tax statute, and also that means taxpayer doing something what the policymaker expect him to do. Taxpayer doing something what policymaker expect him to do. The tax policymaker expect some people to invest in information technology. They are investing and claim the tax. Then that is we call the tax planning. There are no any. Always taxpayers are entitled to plan their tax matters, and thereby they can reduce the both government policymaker and the taxpayer equally get the benefit. Why? Policymaker expect for the taxpayer, he fulfill the expectation of the policymaker. No any, though they have a expenditure element, government take some benefit, the expenditure, the foregone is benefited through other things. But tax ordinance is not that. In the taxpayer doing something what policymaker did not expect him to do. They always make use loopholes of the tax act and claim the exemption. As I explained, that the government expect investment in industrial tool manufacturing. But one company make use that provision and interpret the words. They manufacture other products and try to interpret as the industrial tools. Then they make use the loopholes on the taxing statutes. There are some cases on that basis. But though on that basis evidence, they have not paid taxes for some years, still they argued and they delay the payment of taxes. That is all the one evidence scheme. Then other thing is against then we know the tax planning and evidence. Other one is the tax evasion. Tax evasion is very different. Tax evasion is they are not make use the loopholes of the tax institutions. They are evade the taxes through deceptions. They fraud. They are not declaring. They are not declaring their correct income. They are not. They are high expenditures are claimed. Like that, they are frauding, and also they are not correctly reporting. They are not correctly ascertaining their profit and all. That is we call the tax evasion. Tax evasion is the devices, the deceptions, or all other elements. Fraud is deception and deliberate aspect. The deliberate is doing it. In tax planning and tax orders, they are working the parameters of the taxing statute. Here they are not working within the parameters of the taxing statute provision. General that evasion of tax is not to be allowed. In ordinary speech, the item would avoid and evade the interchangeable, the legal usage, particularly the relation to taxes. There is a useful distinction between these two items. The fraud is a decision deliberately practiced in the course of securing the unfair or unlawfully. Illegally they are doing all those things. Right? These are in this text open. You can get some idea for the full idea for what are the reasons for the avoidance and evasion, right? reading this document, you can get the tax gap is also I have explained here. Right now you have learned all the areas of the taxation. Generally you know the make any research for this one. To sum up this session for exam, now I have already given the one assignment. I asked to describe the different computers method in the Act of 2011, Act number 2010 of 2006, and also what are the sources, on what basis different rates are applied, and therefore you can read the section 2 and the 3, and also read the other tax rates and all. On that basis, you can prepare that assignment. For exam, where we have learned the taxation partnership and the taxation of partners, and therefore partnership tax and the partners tax liability have to be computed in corporate taxation. Some also come in that you have to adjust. You have to prepare the adjusted business profit and separate the source of income and company statutory, assessable and taxable income of the company, and also you must have the knowledge to compute the dividend tax and also the deemed dividend tax. Deemed dividend tax is computed based on the distributed profit. Distributed profit is computed based on the previous profit. Make some adjustment to the economic depreciation and the fixed asset purchase and the tax payment, and therefore you must have a little idea for the some idea of the corporate taxation. Again, especially the separate source of income, the interest and dividend are the separate source. Those are not represent the business profit, and therefore you have to remove on the business profit that the other source of like interest and the dividend and the interest income. Once the interest income is represent treasury bill and treasury bonds, only you have that is the net interest received, and therefore you have to gross up the treasury bill interest divided by the interest by 90 and multiplied by 100, and the difference between the 90 and the 100 is the net, and the gross is the notional tax credit. On that basis, notional tax to be credit, residual tax are the tax credit again the tax payable, especially in the capital allowances rates to be must have the knowledge of the capital rates allowances. What is the rates applied for the building, plant and machinery, patent rights, and also the motor vehicle leasing adjustment, and all other adjustments come in the advertising or some expenditure allowance is 25%, 75%, 20% to be disallowed, depreciation to be added, entertainment, donations are come under the qualified, not the business spirit. Then therefore we have to make some adjustments, and all in addition to that we have to prepare. Now we have learned here the tax expenditure and the tax avoidance and evasion and all. You must have a little idea about this also. And again the individual taxation, you have to compute the tax liability of individual, and therefore you must have a little idea of the then I will discuss here the compute the tax liability of the individual, and therefore you must have the knowledge of the compute the how to compute the income of each source. Renting, when we compute the rent income, different computers methods are involved. For income, rent income is computed individual. We take the gross rent income and reduce the rates paid, and again allow the 25 repair allowances. In other case, the net annual value is computed. We take the rating assessment and reduce the by 25% of repair allowance. On that basis, we compute the on that income. When we compute the interest income and the royalty income, no deductions are allowed. On employment income, all the benefits are included. Likewise, on that basis, you have to compute the methods to be studied. On that basis, I will give exams. You have to sums to be answered. Therefore, 3-hour paper. On 3-hour paper, one question also come for 20 marks. 80% is given for us. for an exam only for 60 marks is given. For in my paper 100 marks is given, but a portion for a 60%. For 100 you have to 20% marks is given for the one written one, not the you have not the only for answer question, not the sums is involved. That is easy for you to prepare. Right? The semester is taxation sessions are closed from today's. Thanks for the all students who are physically present here and attending the class, and also the also the listen to me through the online connection. Right? Thank you, Pavi. I wish you all the best for your exams. Thank you.